The IDR waiver, also known as the IDR account adjustment, could totally change your life as a student loan borrower, and it's not too late even if it's already expired to benefit from it. So the reason that is what is the IDR waiver in the first place, you might ask? It's this big program that was put in place by the Biden administration to help people get a lot more months or years towards forgiveness credit. Now, the way it works is if you were in any kind of repayment plan whatsoever, or if you were in a long period of forbearance or deferment, you get extra credit potentially towards your forgiveness date if you're pursuing forgiveness for your federal student loans in an income-driven repayment plan. Now, this program ends, but it can keep going for you in some capacity. And the reason is this IDR waiver account really applied to every single student loan borrower. It, if it did increase your payment count in some capacity, even if it's past the deadline, you can still benefit from it. And I'm going to show you exactly how. So I'm showing something that we put together from a hypothetical borrower situation. And this shows exactly how the IDR waiver benefited people while it was still in place. And then it shows how it could benefit people even after it's over. So this borrower's got a lot of different types of loans, right? In total, I think there's 20 plus loans here. There's $180K of total loan amount. And there's one loan that's got a lot of different credit than the other ones. So this loan in particular, the way you do this is you look through the file from student aid, federal student aid website, and you can figure out just by calculating, manually, if you don't have a tool like this, how long you were in some kind of payment plan. And then you can also look and see, what kind of length of periods were you in forbearance, right? So if somebody's got a $6,000 loan out of 180K that's got more credit than these other ones, which have 95 months worth of credit, then during the IDR account adjustment, what you could do is consolidate all these loans together and get whatever loan has the most number of credit on it counted towards the entire loan balance. So during the IDR account adjustment or IDR waiver, you can consolidate everything together. And then since this loan has got the most credit, the entire consolidated loan would get whatever this loan is that has the most credit applied to the whole thing. Now, the IDR waiver has certain rules about payments, qualifying payments, and time and forbearance that would count towards forgiveness. So if you're going for public service loan forgiveness, you do have to have been employed at a qualified employer while you were making payments or being in forbearance for it to count. Now, for people going for 20 and 25-year forgiveness, now you can be at a lot of different types of employers for that or no employer at all, right? And so let's just pretend that this person is going for 20 or 25-year forgiveness, say on the SAVE plan, for example. Well, they have 120 months of some type of payment they were in, and then they also have 24 months of consecutive forbearance that they ended up on, let's say. And so if they were on 24 months of consecutive forbearance, the IDR waiver test essentially says, well, that's over 12 months, and so that would count towards forgiveness. And so to figure out what you would get by consolidating during the IDR account adjustment, you would take that 120 and add it to the 24, and that's 144 months. And if you consolidated all this together, you would have gotten 144 months worth of credit. Now, how does it work after the IDR waiver ends? So the way you would figure that out is you would need to look at something called weighted average. So remembering from high school, weighted average is essentially taking, the percent of something that as a percent of the whole, which in this case, 6,000 divided by 180K is roughly 3% of the total loan amount. And then you would multiply that 3% number times the total 144 payment count, and then add that to the 97% of loans that only have about 95 months worth of credit. And so you do that calculation, and it works out to about 97 months of total forgiveness credit. So does that matter? Well, in this case, you would save 2 months of payments if you were going for forgiveness on an IDR plan if you consolidate after the IDR account adjustment ends. And, is that worth it? Well, if you were going to recalculate your payment to a much higher number, that would not be worth it. But if you were doing this at a time when you have to, recertify your income-based payment anyway, well, then that might be really worth it because you're saving 2 months of, payments that's taken away from the end of your forgiveness journey. So that's a really large amount of money to save. So if you think about, depending on how much money you're making, of course. So if you think about what is the IDR waiver, what is the IDR account adjustment, what is it going to do long term? Well, for people who consolidated, you'll have to be really careful to make sure that all these prior loan amounts get added into your total amount of credit when eventually they make this update. And then if you miss the IDR account adjustment and you're only getting the weighted average of what you consolidate into your loans combined, then you just have to make sure that what the loans that you do consolidate have correct individual payment counts that should have been adjusted during the IDR account adjustment, and then that would hopefully flow through to that new consolidated loan. So if you want more stuff, just comment away, ask what any questions, clarifying questions that you've got, put them in the comments, and also follow Student Loan Planner for more stuff like this.